Thank you, friends. You're most welcome once again to our session as far as revision for advanced financial management is concerned. We are going to move on to question 3. This is in respect to the September 2015 pilot paper. In the September 2015 pilot paper, question 3 was talk about, we are saying, the pilot paper, September 2015. We want to now look at question 3. Question 3A, it reads, briefly discuss the meaning and importance of the following terms as used in the option pricing. As you can see, we have the delta, we have the theta, Roman 3, we have vija, we have Rio, we have gamma or gamma. Part B, or before we go to part B, let's try to explain some of these items. That is delta, theta, vija, and Rio, and gamma. When we talk of delta, it measures the change in the option price as the value of the underlying, where moves by 1% is measured by ND1 in the Black-Scholes pricing model. ND2, theta, measures the change in the option price as the time for expiry increases. The longer it firms to expiry of an option, the greater its value. Having may be used to estimate by how much the value of an option will fall as firms to maturity reduces. And vija, it measures the change in the option price as a result of 1% change in the share price volatility or variance. As the volatility increases, the value of both put and call option will increase. For Rio, means the change in option price as a result of change in interest rates. Option prices in general are not very sensitive to interest rate changes. Gamma means change in option pricing as a result of changes in share prices. As the stock prices increase, call option value will also increase. We move on to part B. In part B, we are looking at, assume that your company has invested in 100,000 shares of Usaidizi Limited, a manufacturer of light bulbs. You are concerned about the recent volatility in Usaidizi Limited's share price due to the unpredictable weather in Uganda. You wish to protect your company's investment from possible fall in Usaidizi Limited share price until winter in 3 months' time, but do not wish to sell the shares at present. No dividends are due to be paid by Usaidizi Limited during the next 3 months. Market data, we have the Usaidizi Limited. Current share price is 20 shillings. We have the call option exercise price is 22 shillings. We have the time to expiry, there is 3 months. We have the volatility of Usaidizi Limited shares is 50%. That is the standard deviation per year. We have assumed the option contracts are for the purchase or sale of units of 1,000 shares. Required 1, devise a delta hedge that is expected to protect investment against changes in the share price until the weather changes. Delta may be estimated using ND1. Remember, as we must have said, delta is actually the change in the option over the change in the change in the prices, in the share prices. We are going to look at that, the change in option over the changes in prices. And we have said that delta is measured or is used, determined using ND1. ND1 is the normal distribution, or is the probability in the normal distribution curve up to D1. We are going to see that. Then Roman 2, you comment on whether such a hedge is likely to be totally successful. Now, remember, friends, this takes us back to the Black-Scholes model. Black-Scholes model, Black and Scholes model, the Black and Scholes model. The Black and Scholes model, which Black and Scholes, these scholars came up with a model of determining the value of a call option and definitely the value of a put option. In that process, instead of us going directly to determine the delta, we use this position to also explain the Black-Scholes model or to also explain how to determine the value of a call option. But if it's the value of the delta, is simply the ND1, which we are going to get in the process. Now, for visual purposes, you need to remember, according to Black and Scholes, the value of a call option will be determined by the price, ND1, that is the share price. We can use P or we can use S. We can use P or we can use S. P meaning is the price, the current price of the shares. S can also mean the price of the share per share. Then we subtract this is the exercise price. We can use X or we can use E. Exercise price, you divide it by the exponential constant of 1, whereby we have risk-free rate and time. Then you take the ND2. That's exactly the position that we need to know. Alternatively, you can say the VC is the value of a call option. This is equal to, as I must have said, S, ND1, I can say X, then exponential constant of 1, RT, but this is negative, then I bring in ND2, just like that. That's an option of calculating the value of a call option. Now, friends, we also need to go further and try to know how do you calculate the D1. How do you calculate the D1? The D1 will simply be, you take the natural logarithm and you take the price, you divide by the X, the exercise price. Then on that note, we are going to add the 0.5 variance plus R into T, that is time. The time will always be measured in years. Then you divide this one by the standard deviation and square root of time t.